Hey guys, welcome back. Today I want to cover with you financial instruments that you can use for wealth creation. In my last video I talked about the different plans that you can create that go along with your investing strategy, like long-term, medium-term, and short-term. Now you want to make sure that your personality fits into your goals as far as your plan when it comes to short-term, medium-term, and long-term goals that you might have for your investing plan. So make sure that your personality fits into that. Otherwise, you're going to have a hard time sticking to it. But today I want to cover a little bit about the investing, the different types of investors. Now, yesterday I covered a little bit of that, and I said there was two types of investors. There were, just your typical investors, and then there was speculators. Okay, now today I want to cover active investors and passive investors, because there's two types there as well. And really these have to do with your personality. Okay, your passive investor would be like people who are investing in the 401k plan. And the reason why it's considered passive is because, well, as Warren Buffett says, nobody's going to manage your money better than you. Charlie Munger also says, which is, Warren Buffett's vice president there at Berkshire Hathaway, he also said in an interview, I believe it was at the Columbia College University, he said that, you're better off if you take all your eggs and you put them in one basket and you watch the basket. Okay, so with passive investors, though, they don't do that. Alright, because it takes too much time. These would be normally your employees who invest in like a 401k plan. Now, your 401k plan is usually managed by a fund manager that the company hires. Okay, it's because you're an employee, you really don't have time, you don't know what you're doing when it comes to investing, so you're allowing somebody else to take care of your funds for you, and you trust that they're going to go ahead and put them in the right area for you, right? Well, then you might get a good return on that, and if that's what you want to do, then go ahead and keep sticking with that. But let me tell you why that might be a little bit dangerous. The reason why is because if you go back and you look up the ERISA Act, which is the Employee Retirement Security Act, or actually it's IRSA, I think that's how it's pronounced, is IRSA, the Employee Retirement Security Act. In there, if you read through the documents, it basically states that the government is in charge of your 401k plan. And it was actually created by the government. Now, a lot of people found out the hard way back in 2008 and during the flash crash of 2010, if you had your money tied up in a 401k, chances were you lost probably 30 to 40% of your 401k. Not everybody did, but a big majority of people here in America did. And there was trillions of dollars that were wiped out overnight because of that. And again, it came back to your 401k plan. Now you want to try to stay away from that if you're an investor. You don't want to lose money. The name of the game here, Warren Buffett also said that, there's two rules. Rule number one, try not to lose your money. And then rule number two is don't forget rule number one. Alright, so try not to lose your money. So that's passive investors. Active investors, on the other hand, are a little bit different. They're people like me who want to watch the eggs in the basket. They want to watch the basket, meaning that they're doing a lot of research day in, day out on the different companies that they're invested in. They're paying attention to every little detail when it comes to their investments and where their money is sitting. Because here's basically what it comes down to. You have to keep your money moving. Alright, I've told several people who've come to me in the past, when you're looking at investing, you need to make sure that you keep your money moving. And the reason for that is, well, like I said, you don't want to lose money. So, you know, in my last video I covered a situation that I was in where a company had some accounting errors, and I ended up losing $2,000 pretty much overnight, but I had an exit strategy, and I was able to pull out and not lose any more money, and then I put my money somewhere else to make my money back. So I was basically able to stay in the game, you know, due to an exit strategy, and continue investing, and that's what you want to do. So when I say you want to keep your money moving, that's what I'm talking about. So let's go ahead and the other thing you want to do, I'm going to cover when it comes to investing, is your circle of interests or your circle of competence. And basically what that would be is, you know, there's different industries that you could invest in. I believe there's about 18 different industries that you can look at investing, like retail, natural gas, energy sector, mine's drawing a blank here, I'm trying to think of some other ones here. You know, airlines, you know, transportation, stuff like that. What you want to do though with your circle of interests, if you're investing, guys, make sure when you're investing that you're putting your money someplace of interest. Like, you know, take a look around at the different sectors and the industries that are available to you, and go with something that interests you. Because here's the thing that I've noticed: if you don't have any interest in the industry that you're investing in, you're gonna have a tough time sticking with it. Especially if you're trying to be an active investor and not lose money. You know, it's gonna be hard for you. Excuse me here. It's gonna be hard for you to go ahead and, you know, read the articles day in, day out, or weekly, you know, and keep track of the markets in that specific industry. So you want to make sure that it's something that you love, you're very passionate about, something maybe where you want to start a business in that sector, and pay attention to it, but make sure it's something that interests you. The other thing is, when you're investing, and this is something you don't want to do, highly advise against it. Warren Buffett talks about it quite a bit. He says he doesn't invest in anything that that he doesn't understand. So if you don't understand something, don't do it. I mean, it's pretty simple. It's pretty black and white. And if you stick with that, I think you're gonna be okay for the most part. But like, you know, here's you, right? And let's say you're interested in computers, for instance, because you understand computers. Now, if somebody comes along, you know, outside your circle here, or you got 2 or 3 people over here, you know, and they're all talking about different investments that you can get involved with that have nothing to do with computers. Why would you invest in that? I mean, now if it makes sense and it's something that interests you, sure, go right ahead and look into it. But if it's outside your circle of competence and it's something you don't understand, why would you get into that? Because chances are you're going to lose your money. You know, there's a quote that was mentioned in my 67-step program that I was in with Ty Lopez, and it was the quote, if you don't know who the sucker in the room is, it's probably you. Well, there's some truth to that, so make sure that you're not the sucker in the room, okay? So yeah, stay with stuff that's in your circle. I would highly advise being an active investor. You can still be a passive investor, you know, so if you got a 401k plan going, go ahead and stay with it. But, you know, you want to try to increase your returns, you know. You want to try to stay away from losing as much money as possible, and if you can manage your money, you're going to have a better chance. Because the other thing is, there's a lack of control with 401ks. There's a lack of control with the amount of funds that you can get involved with. A lot of the 401ks don't offer dividends. Okay, they're just reinvested. Now, there are some 401ks out there that probably do offer dividends, but I haven't really seen a whole lot of them with companies I've been involved with. And I've been involved with some pretty big companies like, well, I worked for the government doing contracting for 3.5 years. And then I worked for another company that, had a net worth of over $2 billion. So I worked for some pretty good sized companies, but I've never seen in their 401ks anything that talks about dividends or dividends are included in their funds that they offer. Sorry, I have to clear my voice here. I get to talking so much sometimes my voice gets a little raspy. So yeah, forgive me there for drinking during the video, but trying to keep this as real as possible, Let's see, regular stocks. We're going to go over financial instruments real quick, and I'll kind of explain them to you, and then I'll go through the taxes on them. Regular stocks would just be just that, regular stocks. They don't usually have a dividend included with them. Some of them do, but a lot of them don't. They're just regular stocks, Companies that are just getting started, companies may have been around for a few years, maybe multiple years, they just don't include dividends. There are some, again, that do, but, the taxes on regular stocks are 35%, which is the max capital gains tax. So if you invest in any regular stocks, you're going to be looking at about a 35% capital gains tax on that. It might be a little bit lower, depending on how much income that you make off your investment during the year. And normally that's determined through the different tax brackets. Then you got dividends here. Dividends are where you would invest with a company, okay? Let's say I own a company, and you want to invest with my company. What I do, basically, is I take your money, and in return for investing with my company, I'll give you money back, just for investing. Now, I love dividends because it's a great way to create passive income. I don't know if you're familiar with who John D. Rockefeller is, but they had an interview with him, years ago, and they asked him, what was one of his most memorable moments when it came to business, just on a daily routine that really made him keep going and motivated him. And you know what he said? He said the most memorable times for him were when he went to the mailbox, monthly, and he was checking his paychecks and watching his paychecks that he was getting in the mail from his trust that he invested in. He was watching those increase every single month. And he said, compounding interest is one of the most powerful things out there when it comes to wealth creation. And because of, his dividends that he had in his trust, he said, I don't really have to work. If I work, it's because I choose to work. So dividends, that's what they do. And I'll explain it real quick to you. Basically, with a dividend, let's say you have a dividend that's got a $20 share price. If you look on Google Finance or you look up any of these stocks publicly, normally what they'll do is they'll give you the dividend. So it'll be like 19 cents / $20. Well, what that means is they're paying out 19 cents on each share. So if your share is $20, you pay in $20, they give you 19 cents back. So that's how you would calculate your payments that you make, or the payments that you're receiving when you invest. You just simply take your amount of shares that you're buying, and then you times it by whatever the dividend is. Now there's 3 different types of dividends that I've seen. There might be more out there, but these are the ones that I stick with because these are the ones that I'm interested in. Again, it's your circle of interest or your circle of competence. Um,